Welcome to the Rose Show podcast. Thank you for joining us today. I'm Rosanna, your host, and I'm here with Michael Kramer, founder of MOTT Capital and creator of Reading the Markets, a Seeking Alpha marketplace service. Michael, your focus is on long-only macro themes and trends. You look for long-term thematic growth investments, and you use options data to find unusual activity. You have over 25 years of experience as a buy-side trader, analyst, and portfolio manager. And you have a really wonderful way of explaining the twists and turns of the stock market, which can get very complex. And you do it so simplistically and so much fun as well. So I'm so honored to have you here today, as well as call you a friend. So how you doing, Michael?
I'm doing well. Thanks for the nice intro.
You're welcome. Well, you deserve it. You're so awesome. So much love your Twitter tweets and your Seeking Alpha articles. And that's actually how I came across you, by reading your articles, which I love. And they are totally in line with my thinking, as we've discussed on numerous occasions. So, okay. So today, let's begin. We're going to talk about Mr. Powell. He did speak today, and we know these are changing times, as we will talk about, with the equity risk premium, the risk-free rates rising higher than the earnings yields of the markets. And we've gone from an expansionary monetary policy to more contractionary monetary policy. So what are your thoughts on what Mr. Powell said today, Michael?
Well, I mean, I think he's pretty much, again, going with this idea that they could be anywhere between 25 and 50 basis point rate hikes. I think the market had largely discounted a 50 basis point rate hike at this point, thinking it was no longer probable. I think Powell obviously put that back on the table, and it's going to be dependent upon the data, right? I mean, if the data continues to surprise to the upside, you're probably going to potentially go back to a 50 basis point rate hike pace. And he made it very clear also that rates are probably going to be higher than where they thought in December, and that the March dot plot summary of economic projections is going to reflect a higher peak terminal rate, and it's probably going to be, I think, in the 5.5% or higher number.
Absolutely, I agree with you. You've been right on the whole time. I think we've had these discussions, as anyone can see. We've done many podcasts together, I think almost monthly, and we've been saying the same thing. I believe Powell said, to quote him, "If totality of incoming data indicates faster tightening is warranted, we are prepared to increase pace of rate hikes," exactly as you summarized. So we can anticipate that it is data dependent, and if the data does not improve, they will go higher for longer and faster if need be. And it appears to be necessary. When we look at, and you and I both love looking at the Cleveland Fed, and we see that for February, they're still anticipating a rising core. I believe the core 0.45 around there percent month over month. And the CPI still rising 0.54% month over month. I mean, we're still rising month over month. Inflation is cumulative, and we're printing numbers of 5.5 core year over year and over 6% year over year. You and I both know that's significantly high, and I think everyone can agree it is high. So they have their work to do.
Yeah, I was just pulling it up, and that Cleveland Fed's estimating a 5.5% core CPI year over year and a 6.2% year over year headline. And to be honest, the inflation swaps market is not that far behind at 6.1%. Analyst estimates at 6% seem low. And the most really surprising thing, I think, all of this, and is that not only is the expectation for February rising, but the whole curve of how the market sees inflation kind of progressing over the year is rising. In January, it was laughable that the market saw, inflation hitting 2% by June. And now that number is well over 3% again. And so you know, if you keep getting data points like you got in January and February so far, you know, actually the ISM manufacturing prices paid increase for the first time in many months and actually went back into positive territory, suggesting that prices are again rising for manufacturers, which could suggest that good prices are actually going to start rising again. And what's really scary about all of this, and no one seems to think about it, is that we have high inflation in oil and gasoline prices have come down dramatically. Could you imagine where inflation will be come June or July if we have gasoline back over $4 a gallon or $4.50 a gallon, and you have oil back to $80 or $90 a barrel? Well, it is about 80 now, but I mean closer to 90 or $100 a barrel. Could you imagine where the inflation rate will be then? I mean,
Exactly right.
and that's really the scary part, is that no one is factoring in the potential for higher inflation due to higher energy costs, right? And higher energy costs just filter in through the economy. And not only that, but you've seen China come back online. They have a plan to hit a 5% GDP growth rate this year. And that's going to stimulate demand. That's going to stimulate need for gasoline. It's going to stimulate need for oil. It's going to stimulate a need for agricultural products. You're already seeing the impacts on things like iron ore and copper prices. You're seeing the Baltic Dry Index go vertical in the last week or two. So I don't think this inflation fight is over. And I think that it's just going to be a much harder road than what the market had discounted in December and January.
Yes, and interesting when we see now the Fed funds future for December is now finally showing no rate cuts. I remember not too long ago, I think it was Benny back in January, it was showing a potential rate cut. And I remember we both had tweeted about it when we looked at the Cleveland Fed, and we saw now there's no reduction in December. Both of our opinions were that there shouldn't be any rate cuts. I think they were being overly optimistic about
Sure.
that. And now goods, take the good, like exactly, excellent point that you mentioned. Now we know during COVID, there was an inflation in goods. I mean, we went shopping, everyone was at home shopping, good prices went up. And then we had supply shocks as well, you know, all those issues. We don't need to go through them all. But at this point, how much lower can there be a deceleration in the goods? I think there's probably going to be, like you said, energy prices, gasoline may very likely increase, and you know, we're not going to be seeing that deceleration in goods, and maybe an acceleration. Services have proven to be very sticky. We had the recent CPI. I pulled it up and I was going to look at it. I wanted to just discuss that. We saw services increasing 0.5% up month over month, increasing. Shelter 0.7% up month over month. Transportation services 0.9% up month over month. So we know that services are a function of employment and labor, and we have a very tight labor market. So there are a lot of issues that really point towards inflation remaining elevated and possibly reaccelerating. You know, Deutsche Bank came out with this wonderful quote. They said that once inflation goes over 5%, it can take up to a decade for it to come back down. And this will take time. And the Fed has their work cut out for them. And, you know, when you look at the Fed funds rate, have you looked at that watch tool? They're now saying that 50 basis points, like you said before, there's about a 50% chance in March we could actually get a 50 basis points. Last month, I think it was at only 9%. Now there's like a 48% chance. So
Sure.
we're looking, yeah.
Everything has changed with his speech today. I think, you know, I think that overall, I mean, you know, I don't know. I mean, to me, I look at things and it just seems obvious to me that, that prices aren't coming down. I mean, today you just had used auto prices from the Manheim auction site show that used autos increased by 4.7%.
Wow.
In the month. So that's the second month in a row that used auto prices are rising again. I know I just had to get another car and it was not fun trying to find one, you know,
Yeah.
and, you know, here on Long Island, they don't have a lot of inventory, and the things that they do have inventory for, in our case, we needed something bigger. and you couldn't find one, and you couldn't even find the used version of them. And so, I mean, it's just, you go out to eat, it's very expensive. I keep track of house prices where I live, and I expected them really
Where
to
we live, we're
where we live.
neighbors.
You don't live that
Yeah,
far from me.
yeah.
I expected house prices to really start falling dramatically, given a 7% mortgage rate at one point. And you would never even know that mortgage rates have gone up, because prices haven't come down, and it's more of a function of supply and demand. And factor in that there are 5 million more workers not in the labor force today than what there were pre-pandemic. And that's a large part of the problem, is that we just don't have as many workers anymore. And because there aren't as many, it's creating this sort of shortage, which fuels
Yeah.
higher wages, and which fuels higher prices, which becomes a circular reference.
Yeah, it's
And
like a wage price spiral.
right. So
Exactly, absolutely. Excellent points. I've noticed it's a historical low inventory for housing, especially in our area. You and I, Mike and I are sort of neighbors. We live not too far from each other.
no.
And so I've noticed in our area, it's not only is there a rise in remote work, so less people are needing to move, but people are locked into those lower rates. I mean, of course, there are many factors, but people aren't wanting to sell. So we'll see what happens in the next 6 to 12 months. But as of right now, I have some friends who are local real estate agents, and they've told me the market is hot. Our area, New York metro area, people are still trying to move out to the burbs from the city, from New York City. And there's a low inventory. So that's that supply and demand, which is what makes up the markets.
That's right. If you need to buy a house, you need to buy a house. You need to live somewhere,
Exactly.
So you just have to. And if you're not buying a house, you're renting something somewhere, and rents are incredibly expensive
exactly.
too.
Exactly. You
So,
take the words right out of my mouth. Yes, exactly.
you're damned if you do, you're damned if you don't, and that's why you're not really seeing, inflation really cool. Is personally, I think that there was a lot of stimulus created, and during the pandemic, our nominal GDP has grown by well north of 25% in 3 years. I mean, that's tremendous growth in a really short period of time. I mean, what did they think was going to happen?
Exactly. They increase the
Right.
money supply. And then,
Right.
there are 3 ways to reduce inflation. You raise rates, you reduce the quantity of money via balance sheets and tightening of credit. And then number 3, you reduce government spending. And that government spending is not getting reduced. It's mass government spending, as you've been tweeting about it in your charts. And, that's about 40 or 50% of GDP is this government spending. So maybe that's what's holding up that number and making it look much better than it actually is. It's just that the government's just continuing to spend. So,
Sure.
and then the labor market, like you said, we have a lot of data coming out this week, and we have lower labor participation, and that's important. That's key, and that's
Right.
also what's fueling this higher.
And that's a function of people, moving to retiring or just leaving the labor force. On top of it, no one ever really thinks about or talks about the fact that, minimum wages increased dramatically in many places as well. And so that's
Yeah.
going to also sort of put upward pressure on wages.
Exactly.
And so,
And that's calling the higher wages that we
right.
have a significant wage growth. And so it's all those issues that we have. And like we said, wage price spiral. And we have benefits ending, some student loan forbearance. I'm not following it, what's going on with that at all. But if that does
It's been a long
end,
time since I went to college.
I know, right? But if that ends, if all those benefits and that forbearance ends, maybe that will force people to come back into the labor force. We'll have to watch and see. I mean, also, there are a lot of layoffs going on. And, as business profitability comes down, they're going to have to reduce costs, and maybe they reduce their workforce even more. And we'll have to see what happens in the near future as well. We could talk about earnings. Margins are compressed, and we know that. As rates go up, there's going to be a higher cost of debt and capital, and that's going to affect these companies' bottom lines. It's very important to note that revenues are also being held up by inflation, and inflation works both ways. So it's not necessarily we have more output or volume, it's, higher prices. So it
Right.
hurts both sides.
Yeah, and you saw that kind of show up in some of the staples earnings results more recently, where it wasn't that they were selling more volume, it was just that they were able to pass on more price increases, and that's really what drove a lot of it.
Hmm.
And you can see it in even S&P 500 earnings, where earnings are coming down rather dramatically and sales are just holding up, and that's just all your margin compression and all
Hmm.
that other stuff, and that high inflation rate keeping sales growth up.
Exactly. There's just productivity's down as well.
Correct.
Efficiency is key, and there's just a dilution of value, and that's what I've been calling it. We're just getting less output for every input. Do
Right.
you think there could be an earnings recession? I mean, for quarter four, I was looking at the blended earnings decline for SPX, and I think it's about 4.6, something like that percent. So that's the first time there's a year-over-year decline in earnings since I think I see quarter
Probably.
three, 2020.
Right.
So if we get 2 quarters, I guess that could be an earnings recession. But they are lowering their guidance a little bit. I mean, if they revise lower and they come back and beat, that's like the whole mirage of, oh, earnings weren't so bad.
Right.
But overall, we're seeing a decline. I think in December it was only -3 something percent. Now it's got revised even more negative. And then the guidance is not so great, and that's important. We always want to know as investors, the future.
Sure. And I mean, the data seems to suggest we're probably going to get a couple quarters of negative
Mm-hmm.
EPS growth. But on the year, I have a feeling we're probably going to be around flattish,
Oh, okay.
because I think right now the estimates are for basically a rebound probably in the third to fourth quarter. Again, this is all playing out sort of strangely this year, because I think a lot of people were expecting, the first half of the year to be sort of the rough part and the second half to be the easier side of it, right? But I think it's actually may end up going in reverse, where
Mm-hmm.
the first half is the struggle and the second half, where I'm sorry, the first half is the easy part and the second half is a real struggle. But again, sort of a high inflation world will buffer a lot of those effects, because your sales growth will continue to hold up. And it's really going to be depending upon, how much the margins are hit. And some management teams are going to be very good at managing those margins, and some management teams aren't. And so I think it's going to make things, more challenging. And I think it's going to make it a little more confusing in terms of what state it is that earnings are in and what state of the economy really is.
Absolutely. Agree. Well said, Michael. I think we had this discussion before that if inflation comes down significantly, then we probably will have a severe recession. I mean, it will be really impacting us negatively. And then at the same time, if inflation stays elevated, we may escape that side of it, but then we'll have high inflation, which isn't good. So it's like a double-edged sword. So it's not a good scenario. It's unfortunate, but this is all part of the economic cycles and business cycles we are fully aware of. And this will take time, and most likely probably take a few years to go through this. There's someone that I had spoken with, Bob Elliott. You may know him.
Sure.
He called the first half of this year a transitory Goldilocks. And I like that term. I thought that was funny, meaning that, we're going to probably have, like you just said, more pleasant time period. And then it's the second half of the year that we're going to have to pay the piper.
Right.
And just, right. And just, so buckle up. We're probably in store for a lot more volatility.
Well,
And
it all depends again on, how much more the Fed needs to raise rates and
mhm,
where it ultimately goes, right? Because, the higher rates go, the worse the impact should be over time. Although I think that monetary policy, I think, moves much quicker today than it did, 10 or 15 years ago, even, because it seems to me that in the fall, the economy was slowing down very quickly, and then financial conditions all of a sudden started to loosen
mhm,
and everything came ripping back. And so financial conditions now are, at least as measured by the the Chicago Fed, the
mhm.
National Financial Conditions Index, is basically at the same spot it was before the Fed raised rates once.
Huh.
So, when you look at it from that standpoint, no wonder why the economy is expanding again. It's like, we're back to where we were pre-rate hikes. And so that's a function of the market, though. And that's a function of how the market is digesting the data. And so, if we think about that, I mean, that's going to largely, I don't know if I can share my screen with you. I'll show you.
Please do. Let's see. You should be able to just click share screen.
Yeah. Oh, here. So if
I
we
like
look,
your background. That's cool.
that's the Apple. So if we look here at the National Financial Conditions Index for, you'll see that, I mean, it's really rather dramatic in terms of how much we've eased. This is where we were in October. Anything above 0 is considered tight. So you can see we got to, a fairly restrictive area, not quite restrictive, but got up into an area where you could start having an impact. This was all the tightening that took place last year. And so the lower the number is, the easier it is, the more accommodative it is for the economy. And you can see where we are right now. We're basically back to a spot March 4th of 2022. It's as if this whole period of time didn't happen. And so as the market anticipates Fed rate hikes, as the market anticipates quantitative tightening, the market was tightening financial conditions. And because everyone was convinced that we were going into a recession in the first half of the year and was pricing in rate cuts, it led to an easing of financial conditions. And you can see that that's had, a major impact on, the price of
Absolutely.
commodities, on the price of goods. I mean, if you just
Becomes like
overlay a
a
chart of copper, here's a price chart of copper, right? And so, I mean, copper prices collapsed as financial conditions tightened. Notice as soon as financial conditions started to ease, copper prices started to go up again, right? And copper is a really good indicator in terms of economic health. So I mean, it's all there. I mean, and then you can overlay this with your ISM manufacturing prices paid index. And you'll see that the relationship with that and manufacturing input costs. Here again, you can see as financial conditions tightened, those costs were coming down. And as financial conditions have eased, those costs are starting to rise again. So this is why I tend to think that, it's really all going to depend upon, how effective the Fed is at really transmitting monetary policy through the economy. And at this point, that's the real challenge. And so, if financial conditions stay here, the economy is just going to keep chugging along, no matter how much the Fed raises rates.
Michael,
I mean, at some point there'll be a breaking point, but
yeah. What do you think? Looking at these charts, you have beautiful charts here these overlays. I love how you do that. What do you think looking at this and looking at these patterns? Because you're very experienced with studying patterns I love your bear market cycle comparisons. So tell us what you see here. What do you anticipate? I know there are a lot of moving parts and always subject to change at any moment. What do you think?
When you look at this data, if I just kind of make these charts look a little bit better, and get rid of the one for the NFCI, I think it's pretty clear to me what this chart is telling you is that, you're going to see an acceleration in CPI year over year. And I think it's going to be coming relatively soon.
Yes.
You can see here, this is, if we get rid of this chart, you can see there's a relationship between copper and CPI. And more importantly, there's a relationship between, the ISM prices paid index and CPI. I'm sorry, in copper. And so when we look at this, you can see that this just seems to trail with a lag. And if we go back over time, this relationship has been fairly steady, right?
Mm-hmm.
And so the question is do we get a number where we're going to be talking about a CPI print going up again for a little bit? And that's really what kind of scares me, because
Mm-hmm.
if we look at things like service prices, believe it or not, which I just find really, I guess, odd, is that if we look at the service index, right, service index prices paid, there's actually a very good correlation again between service
Mm-hmm.
prices and CPI. That's continued to fall. But what's really scary is when you look at this and you see that there's a very strong relationship between copper prices and the services PMI prices paid. Here's the yellow line being ISM prices paid, the blue line being copper prices. You can see that there's clearly been an acceleration. So my guess would be is that we're going to probably see some sort of acceleration in services prices paid at some point, and that's going to feed through to a higher inflation rate.
Mm-hmm.
Again, you can see the relationship is very strong. So
Yes,
you know
excellent charts.
you know,
Great
you look at
points.
you look at this stuff, and there's also a relationship. Honestly, you can, it's not that easy to track all this stuff, but there's actually what's interesting is that there's a relationship between the CPI and the S&P 500 revenue growth estimates,
Mm-hmm.
and they track each other very well. Also, it's a little slow.
Okay.
Just give it a second. Here
Mm-hmm.
you can see that there's I had changed this yesterday.
These are great. You are you're a master of comparisons. I love these overlays and
Well, I think they're
comparisons.
helpful. I mean, here's your
Very.
yellow line is your, year over year estimate, sales estimates
Mm-hmm.
growth rate. The white line is CPI, right? So if we start seeing sales estimates turn higher, it's probably going to be indicative of a higher inflation rate again.
Mm-hmm.
And, so there's reason to think that, this whole thing with inflation is not done yet, and that we really have to be concerned that the risk here isn't that inflation is going to vanish and that everything is going to be okay, and so the fear should be of missing out to the upside. I think the greater risk still remains to inflation not being contained and for there to be a secondary move higher in it. Because like we said, all there needs to be is a little bit of a spike in the price of oil. Here you can see
Mm-hmm.
oil in white and CPI in blue. All you need is a little bit of a spike in the price of oil or a spike in the price of gasoline for this
Mm-hmm.
whole narrative that has been laid out of disinflation to vanish. And so I think the market is underpricing that risk.
Mm-hmm.
And
Absolutely.
what I think is going to happen over time is that you're going to see the CPI, if the longer the CPI stays elevated, I think the greater the risk becomes that the 30-year starts heading up towards the inflation rate. And that's going to mean that you could have a 30-year rate approaching 5 or 6% at some point if the CPI rate doesn't start coming down. Because you can see very clearly, going back to the early 1970s, that
Mm-hmm.
30-year has almost always been above the inflation rate. This is by far the largest deviation since, and it's certainly been one of the longest, with the exception of this period of time in here. And the only reason why that was the case in here was because inflation was rising at an even faster rate in the late 1970s than what it's rising now. And the 30-year eventually caught up to and surpassed it. And so that's really the biggest risk to this market, is that inflation doesn't come down and
Mm-hmm.
long-term bond yields actually start rising to the inflation rate. Because I
So,
think basically what the market has been doing over the last year has had this idea or thought process that inflation would vanish and that inflation would disappear.
mm-hmm.
and it gave the market and the Fed the benefit of the doubt that that process would play out. But I have a feeling that the longer this process continues, the greater the odds of for even higher rates are coming.
Yes, absolutely. I
And that
love your
gets to,
comparisons. Now, do you see that there are some comparisons with the 70s and 80s? Do you think we could be in for a similar type of situation as we had back then with persistently elevated inflation?
unfortunately, I was only about 2 or 3
The
in the
same
late
as me. We're about the same age.
in the late 70s. So I couldn't tell you what it was really
Yeah.
like from a firsthand experience. And I don't really remember much of the mid 1980s because, again, I was still very young. But, you know, whether or not this is going to play, look, I think the main difference between now and the 1970s is that in the 70s, at least based off of history, right? You know, my understanding of it, that a lot of it was initially caused by oil shocks.
Mm-hmm.
And that kind of fed into other things. But I think the main difference in the 70s and today is that in the 70s you had a positive real wage growth, where in today's world
Mm-hmm.
you have negative wage growth, right?
Mm-hmm.
Inflation
Exactly.
is not keeping pace with, I'm sorry, wages are not keeping pace with inflation. So I had done a paper when I was in grad school, and the story I had written about in 2004, 2005 was about the housing bubble. This was before there was a housing bubble. And I had noted that I had done a comparison between the 1970s and at that point the 2000 and the 2000s, the aughts. And what I had noticed was that low interest rates were driving the increasing prices in housing, and
Mm-hmm.
that housing prices in the 70s were sort of kept low due to high interest rates. But I found it really weird because I'm like, how could housing prices be going up throughout most of the 70s when you had, you know, really high mortgage rates? And what I found was that even though mortgage rates were very high, I found that the wage growth was still faster than what interest rates were and what the inflation rate was.
Mm-hmm.
So home prices were still able to advance. Now today there's a difference because wage growth isn't keeping up with inflation currently.
Mm-hmm.
And so at some point that's going to become a major issue. So I don't really think this is a similar sort of circumstance. And I think that this inflation is more destructive in a way because I don't think that first of all, we have a lot more leverage than we had back then as a country, right? A lot more debt than we had back then.
Yes, much higher debt. Mm-hmm.
People use credit much more freely, right? They have a lot of people just spend on credit, right? Which means that leverage overall is just higher here today than it was then. And so if we start getting into a cycle where wages aren't keeping pace with inflation, it becomes a real problem, especially if people don't have a lot of savings. And so this is why the Fed really needs to get inflation back down, or get it back down to a rate that is consistent with wage growth, so that people can at least afford to do stuff. Because again, it's very expensive to go out to eat. It's very expensive to go to the, I mean, I don't know, maybe they're ripping me off in where around town, but I mean, there was one point, you know, strawberries were costing me $10
It's
for a
crazy.
container. And I went to a couple different
Were
stores.
they organic?
No, they were just a regular
Oh,
Driscoll, Florida strawberries. And now, you know, now they're coming back down. Now they're back down to like $6, which is getting closer to the normal range. But I mean, you notice these types of things. We were ordering dog food, Blue Buffalo for my dogs. We have 2 of them. And I had, my wife normally buys it from Amazon. And I went to the store, and I'm used to paying like $50-$60 a bag for like a big 30-pound bag of dog food. And I went to the store and they rung it up, and the guy's like $98. I'm like, what's $98?
yeah,
He
I
goes,
only
the
got one
dog
bag.
food. And I was like, when did dog food become $98 for a 30-pound bag? And he goes, I'm like, are you sure that's the right price? And he looked at me because that's the price. And I'm like, okay. So I just paid for it because I needed it. And I went home and I said, when did our dog food become $95 or $100 for a bag? And she goes, I think that's what I've been paying for it. And
Oh
I
my
was like
gosh.
stunned.
Yes, prices are elevated significantly.
So it's everywhere, you know?
Mm-hmm.
Um, I just went to the deli downstairs and I was paying $14 for I would pay, sometimes I'd go and get it. You get like a Snapple and you'd get a turkey wrap. And at that time it was $12 pre-pandemic. Post-pandemic, it's been 14. Now all of a sudden it's 16. So I mean,
Mm-hmm.
you can feel it, you know, you can see it. And
Absolutely.
so it's a problem, you know, especially when wage growth isn't keeping up with the increasing costs. And so, you know, again, the higher and the longer the Fed sort of drags its feet, the more that the market is going to take over at some point, right? Because why should someone invest for 30 years at, you know, a 4% rate or 3.9% rate when the going inflation rate is over 6 and have a negative real yield for 30 years, right? And if that rate doesn't come down.
Mm-hmm.
So the market will eventually adjust for it, and it will adjust for it by rates going higher. And that's going to cause a lot of issues because stocks are very expensive when you
Very
invest
expensive.
versus bonds.
Absolutely. Are you reading my outline? I have my outline of notes, and that's actually the topic I'm going to. I wanted to go into how the PEs for S&P 500 and NASDAQ are still high, and they're very expensive. The markets are expensive, especially when you have risk-free rates higher than they've been, I think, in what, since 2007, 8 time period.
Sure.
I think it's like over 15 years, something like that. And, you know, you're able to get a return, you know, 4.7% or something like that on, you know, risk free. And why would I put my money in the market unless I get better prices, right? I need to be compensated for taking on that additional risk. And the
Right.
equity risk premium, which we both love talking about, and you wrote a great article on it in Seeking Alpha. It's the narrowest it's been. That spread, and it's a spread. And it's the narrowest it's been in, I think, over 15 years. I think you pointed out the NASDAQ earnings yield. And that's the difference between the earnings yield and you use the 10-year tips.
Yeah.
Um,
For the NASDAQ
yeah.
stocks, usually
Alice, yeah, show us that. You have the charts for that as well?
yeah, I was just creating it.
Wonderful. And we'll talk through it
So
for the
here,
podcast
here it is.
people.
This is the spread between the NASDAQ current earnings yield, which is the earnings yield
Mhm.
for the last 12 months. For those of you that don't know, the earnings yield is just the inverse of the PE ratio.
Mhm.
Um, and then this is the 10-year tip rate. That's a quote unquote the real yield, which is basically market expectations of, you know, which is basically how the market derives nominal rates less inflation expectations gives you the real yield. And so, you know, right now the NASDAQ is trading at a 2.15% premium to the 10-year real yield on an earnings yield basis.
Mhm.
And, you know, the problem with data is I think it's really hard to determine where the right value should be, right? Because, you know, was the market right during this 2003 to 2008 timeframe, or was the market right during this
Mhm.
2013 to 2020 period? If the market was right during this period of time, then, you know, the spread isn't that bad. It's actually kind of
Mhm.
fairly valued. If this was the correct range, right, over the last, call it 8 to 10 years, then the market is extremely overvalued.
Mhm.
And so what that tells you is that the market at best is fairly valued, but at worst is extremely overvalued. You know, at the bare minimum, the market is not cheap.
Mhm.
And so, you know, knowing that, my viewpoint is do you really want to be a long-term investor in a market that at best is fairly valued, or do you want to be an investor in a market that's cheap? You want to be one that's in a cheap
Yes.
environment. And so if we're the risk here is that this spread returns to where it was prior to this recent meltdown. And so you're talking about, you know, a 2.15 returning to maybe a 3.15, which is only 100 basis points, but it's only 100 basis points is actually a very big number.
Yes,
So,
absolutely. Because
you know,
as that goes up.
if you're talking about a spread having to go back to 3.13%,
Mhm.
and you know, the tip real yield right now is trading at, you know,
Yeah.
call it 1.53 plus 1.53, you're talking about a NASDAQ earnings yield of
0.66,
4.66%.
and that means
Then you
PEs
do
come down,
1 over 4.66 gives
prices
you a
come
PE
down.
of 21.5. And, you know, if we look at where the current NASDAQ PE ratio is right now, at least on a,
Mhm.
if we, let me see if I can find a trailing 12-month one.
Mhm.
Trailing 12-month. We'll see if this works. 27.
Wow.
So
That's
you know,
significant.
that's a significant difference, right?
Uh-huh. Prices
Um,
will come down. And what
yeah,
range
I
are we
mean,
going to
and
be
even if
in?
you do it on a forward multiple,
Mhm.
you know, you're talking about 23. So you're talking about anywhere between a 10 to 20% correction in the NASDAQ from where we are right now, you know, at a minimum.
Wow. That's
You know,
significant.
10% at the minimum, you know, takes you back to, you know, figure if the,
10,000 something.
yeah, I mean, you're talking about,
Where are we at?
I don't even know,
Hmm.
12,200. You're talking about
11 maybe.
getting
What is
pretty
it?
close back to the lows, I
10,
think.
yeah. Wow. Like in the high tens or something.
We're still going. Yeah, down here. That's the lows. At a minute, you know, if you're talking about a 10% correction from here, if you're talking about 20%, I mean,
Oh, whoa.
you know, you're talking under 10.
Wow.
So that's a lot of risk, I think, to take.
Absolutely. Remember, when you buy is when you make your money. You know, you need to buy right. And you know,
Right.
buying up here is risky. I mean, it's
Yeah, I mean,
expensive. It's
so
expensive.
that's like why I've been super patient. You know, I
Mm-hmm.
recently actually sold some stuff that I wanted to get rid
Yes,
of
me too. I reduced
because
position sizing.
I was like, you know, if I can get 4% even in my money market account,
Mm-hmm. I've been doing the
risk
4 week.
free, why would I
Yeah,
not?
I've been doing the 4 week T-bills, and I've been doing ladders with that. So I remain liquid. I've been doing 1 to 2 week expirations, so maturities. So then yeah, you just have that rapid liquidity availability. But yeah, the 4 week T-bills have been great, you know. So we have a high risk-free rate. Might as well take advantage of it, correct?
Right. I mean, it's certainly, you know, 4% risk free. Take it
I
every day of
know,
the week, I guess, compared to what we've been used to, right?
exactly.
And, you know, considering we don't know really where the path of inflation is, considering that some of the leading indicators are suggesting that inflation may go up or at worst stay sticky, you know, that gives you reason, you know, for pause. I mean, if you look at the Atlanta Fed, you know,
Mm-hmm.
sticky CPI, you're talking about a 6.6% rate, and it's gone, you know, it's gone nowhere, right? Hasn't even really come down. So it's tough to say that, yeah, inflation is good. I mean, because it's 6.5% is a sticky core inflation rate. Imagine if oil starts going up.
Oh, wow. Yeah.
Imagine if gasoline starts going up.
Yeah.
I mean, at some point, you know, the summer driving season sort of kicks in and
Yes.
gasoline prices will go up.
Very true. It's about supply and demand. And
Yeah.
as the demand increases, we may see a tick up in prices. Absolutely. Excellent points. You know, when we compare different time periods, I think we had this discussion before with monetary policy and expansion of the monetary supply. I think it was the 20s, 30s, and 40s can sort of be compared to the 2000s, 10s, and 20s. It's an interesting comparison regarding the monetary policy. I read about that. A few people have written about that. That's an interesting comparison because I love comparing just like you do. And that's how we learn. I mean, we learn from history. You know, history doesn't repeat, but it rhymes. So we learn, you know, different bits of things and from our history and comparing bear market cycles is an excellent, brilliant idea that you came up with, Michael. I love your comparison to 2008, and it seems like it played out very much like that with a lot of the movements. Are you still using that comparison to 2008? Are you seeing some type of alignment still, or has it deviated from
So
that?
I was looking at that actually the other day because I haven't really
I read your mind, you see.
I haven't like really commented on it much.
Yeah.
And the reason why obviously is because it stopped working to some degree. But the other reason too is that I felt like it was conveying the wrong message to people, and I didn't really feel like that was what I intended it to be, right?
Mm-hmm.
And so I just stopped sharing it, right? There's no point in sharing something that is not doing what, conveying the message you want.
Mm-hmm.
And this is this is this is the 2008 comparison, and you can see that it worked very well up into here, right?
Mm-hmm.
And then of course this was the Lehman sort of, this was when TARP failed.
Okay.
It wasn't the Lehman moment, right? This is when TARP didn't pass the Senate and the House,
So
and
yeah.
that created a lot of this. But up until this point, it was a very similar cycle because we had, basically an economic slowdown, and we had a market that was screaming for Fed rate cuts, and the Fed was very hesitant at that point, and you had earnings started to decline. And so that was one of the reasons why it really worked very well. And then it obviously diverted because, history sort of took it on a different course, right? We
Mm-hmm.
didn't have a credit crisis, right? We didn't have any sort of issues. But you can sort of notice that even when we got back to this point in time, all of a sudden it started to line back up a little bit again.
Mm-hmm.
So I'm sort of keeping a loose eye on it. But what I found sort of more interesting more recently is this chart with the Dow.
Interesting. Cool. Exciting.
Because you can see this is the
Oh,
Dow
wow. Yeah.
2000 and the Dow today, and
2000 now? This is cool.
this is from 2000, 1999, 2000. You could see the Dow had this sort of rocket rise here
Yeah.
in 2000, March of 01. And that was very similar to what happened
Mm-hmm.
here. And then it kind
Yeah.
of chopped around for a while, and then it fell off. And again, I'm not really sharing this publicly, but that's sort of something that I'm keeping an eye on as well, because I found it interesting, because I remembered that in 2000, the Dow held up much better than the S&P and the NASDAQ for a good portion of it. And then eventually it fell off, but that was really
Mm-hmm.
closer to the end of the cycle. And so I found that to be interesting. And then, I've been still tracking the S&P versus 1998, the 1998 cycle.
Mm-hmm.
And that's been still sort of working, sort of not. This is obviously getting towards that 9/11 time period, which
Oh, yeah.
obviously we're not, hopefully not going to have an event like that
No.
again. But again, you can see it's been fairly, was a very good indicator
Yeah.
for a very
Except
long time.
for a major like economic or
Yeah,
disaster that occurred.
disastrous shock, right?
Yeah.
So again, that's sort of, something that's been something I've watched. But to be honest, trying to find more comparisons like the ones in the 2008 comparison they're not easy to find, and they're not very often. Here's the S&P today versus, 1973.
Mm.
Got a similar look and feel to it. So,
Wow.
although the market has sort of gone off and risen a little bit, and you could say there's a little bit of an uptrend here, this isn't sort of like anything that's unusual for this point in a bear market, if that's what this still is what really the underlying message is that it's not unusual to see sort of these consolidation phases or periods where nothing really happens for a while, and then bear market just resumes.
Mm-hmm.
And so I don't really think it's over with. I mean, the other one that it sort of lines up with is 1962. But 1962 is obviously a much more positive outcome.
Mm-hmm.
But again, being aware of it is good.
Yeah.
But,
Awareness is key.
but
Absolutely.
again, I just don't see it playing out that way.
Exactly. Well, I love this. Thank you so much for sharing all
Yeah,
your
you can see it
brilliant,
better like this now.
oh, wow.
Yeah.
That's it's a very close overlay,
It
of the
is.
pattern.
Yes. But you can see, so we're at another critical point, right? Because if we start turning down now, then this
Yeah, they'll
kills
break
this
apart. Yeah.
overlay.
And I
If we
agree
keep
with you.
going.
I think that we're not as optimistic as we were then. I don't know the
Well,
exact
I guess this
economic
was around
events.
the time of the Cuban Missile Crisis. I'm not,
Okay. Yeah, that's what you have to do. You have to look at the time period and see what was going on at that time, and then compare. But
yeah,
very amazing stuff. Great comparisons.
yeah.
Love that. Any other comparisons left? That's good.
The only one that I've been doing otherwise is just kind of tracking I've been tracking reserve balances very
Mm-hmm.
closely.
Oh,
Um,
good. Yes, absolutely.
and I know everyone does it now, but when I started doing it, I was kind of seen as a crazy person for it. Um, but again, you can see this is a real time. I have what I call a real time reserve balance tracker, where basically as soon as a reverse repo activity pulls in,
Mm-hmm.
it updates, and once the TGA activity pulls in, it updates. And so there's been a little bit of a divergence right now between the S&P and the reserve balances. I expect that reserve balances will continue to drain. And
Mm-hmm.
I think we're just at a pausing point right now. And what's going to
Yes.
happen is eventually is that as QT continues to drain reserves, this number is going to continue to drop. And that's going to eventually lead to, prices on the S&P also moving lower, which is one of the reasons why I don't think the 1962 scenario is really at
Mm-hmm.
play.
Yeah, too optimistic. There's an anchoring bias that goes on and recency bias. People are anchored not only to the recent, everyone's buying the dip, or they think that, they're going to have rate cuts coming in, and that, rates are too high. And it's actually historically, we're not that high. If we look at all these historical periods, it's only because we had the free money,
No, and
basically.
there's this great chart that if you go to the St. Louis Fed website
Oh, I love Fred.
and you look at this chart, is this it? No.
Excellent. To look at the
No,
rates
this isn't it. This
historically.
isn't it.
Okay.
UK console. Is it console?
Yeah.
Long-term bond yields. This goes back to 1753.
1700s. Okay.
Yeah, but I mean, look at bond yields. I mean, so these are consoles, right?
Uh-huh.
Rates aren't really all that much different than where they are here in the US over time, right? I mean, you can see that rates historically have been, as high as 6% on a historical basis,
Mm-hmm.
6%. And then you had this big sort of unusual period of time in the
Mm-hmm.
70s and 80s, and then we came back down. But I mean, historically speaking, for, from 1753 until, call it 1960 something, rates were typically between 2.5% and 5%,
Mm-hmm.
6%. So this isn't like an abnormal place
Mm-hmm.
to be in for rates. I would say that this was abnormal up here at 17%, and I would say
Mm-hmm.
it probably was abnormal at 0%.
Yes,
This chart
exactly.
doesn't go past the fourth quarter of 2016, but at least it can give you some sort of long-term perspective on where rates are and where they've been historically. Because a lot of, our generation, not so much, but the generation older than us remembers rates being, 12, 13, 14% on a
Mm-hmm.
mortgage. That was an abnormal, at least based off of this history, that was abnormal. And so, and our generation has this view of rates being, towards 0%.
Yes.
And there's just the two extremes, but you can see historically that wasn't the case for a very, very long time. So we may just very well be reverting to the mean at this point.
Exactly. And that's what we were speaking about with the equity risk premium. Could we be at a narrower level, the spreads be tighter, like we were back in 2007? Could that be back to where we're going? Or are the spreads going to
Yeah, I
tightening
mean,
again?
and that's
Like,
the problem. Like
that's the
it's just
question,
it's
right?
really tough to tell. And then, another way you can do it is by looking at the dividend yield of the S&P 500 and using it versus the
Like, what's
10-year
the new norm? Is the norm going to go back to that, or are
the
we in
10-year rate. And
yeah.
you get more data here. But I mean, again, this has been sort of a moving target over the years. And so, this is where we are right now. So the S&P dividend yield is 2.2% below
Mm-hmm.
the 10-year rate. But I mean, there were times when it was much
Wow.
lower.
What time period is that?
This is the 80s.
Wow. Well, that's another extreme time period there, but
Right.
wow.
But I
Yeah.
mean, again, if this is sort of normal,
Yeah, right
then
there. We're right where normal is then.
you could say that
We may need
maybe
to come down even more.
maybe it needs to come down more.
Yeah. Interesting. I guess we'll only know in hindsight.
Yeah,
That's
probably.
how,
That's
that's the
usually
$1 million
that's
question.
usually how it works.
Now with inflation, there's no longer the $1 million question. It's the $1 billion question, right?
Trillion.
$1 trillion question. That's where we're going to
Billion
now.
doesn't even sound like that much anymore
I
when it
know,
comes about
right?
in terms. So
Yeah, exactly. I think we could segue into bond yields. You've been tweeting some great stuff and you've been calling it. Bond yields are going up. The 10-year now is, I think, it's like 3.98, or it's almost like 4%. And we
yeah,
have
it's like
more inverted 10-year, 2-year, almost at negative 1%. And I think the 10-year tips is going to get close to 1.75 as well.
yeah, the 10-2 right now is negative 102.
Wow, it went even more.
Yeah, well, you have the 2-year up 9 basis points today, call it. And the
Okay.
10-year down 2. And that's not that's a pretty normal reaction. It's the market saying that the Fed's going to over tighten on the front,
Mm-hmm.
and that's going to cause slower growth in the back. And so that's not an unusual sort of thing. But again, the 10 and the 2 is just, keeps going lower and lower.
Mm-hmm.
And
What do you think, Michael? You think it's predicting a recession is going to be coming in the future?
it's not yet.
Not with a tight labor market as we have.
No, and so what I like to look at is the 10-2 spread,
Mm-hmm.
2-10 spread, however you want to say it.
10
And I was showing this to my members the other day. I don't even know what this is a chart of.
Your members are so lucky.
But I was showing them this chart, and so if you look at the spread between the 10-year rate and the 2-year, and then you look at the unemployment rate, it's pretty easy to see that the spread between the 10 and the 2 rises ahead of the unemployment rate rising, right? And so this inversion, I think, is continuing to tell us that the Fed still has more rate hikes to go.
Yes.
And I think this inversion is telling us that the unemployment rate is going to either go lower or stay at these levels for a long period of time.
Yes.
And it won't be until what's odd, I guess, is that the 10 and the 2 spread hasn't even flattened out yet, which is really also telling us again that the Fed is nowhere close to done. And and that unemployment is going to stay low for a very long period of time. And we'll see on Friday we're going to get the unemployment numbers, but that's what this sort of implies to me.
Yeah, absolutely makes absolute sense to me as well. And we both, I think, made a joke that watch it go even lower than 3 point. Watch it go to 3.3 unemployment rate. And looking at this, I could see.
I mean, it's not that crazy to think that maybe it could, because if you look at the unemployment rate of 3.4%, and then you look at initial jobless claims, if I can spell here, if you look at initial jobless claims, you'll see that again over time, initial jobless claims, which are in blue, and you have you can see that initial jobless claims are pretty much at their, lowest level of this cycle.
Mm-hmm.
And so if people aren't, filing new claims, then, are we left to believe that, the unemployment rate is not at the bottom. It's
Mm-hmm.
just it's
Yeah,
it's it's one way to sort of think about it, maybe.
absolutely. As the claims go up, then we can probably have the
I mean,
unemployment.
you can see through March and June, the claims were rising and the
Mm-hmm.
unemployment rate was at least staying flat, and then it increased and did some gyrating. But then as soon as claims started to come down again, the
Mm-hmm.
unemployment rate started coming down. So this is sort of implying either flat or maybe a down unemployment rate when we get it come Friday.
Yes. Great thinking. Absolutely. Thanks so much for those charts. Now, looking at the bond yields, you were speaking, I think the 3-month, everything's going up. And you made a great comparison. You were speaking about you're anticipating bond yields to continue to rise.
Sure, if inflation doesn't come down.
Mm-hmm. And this is the 2-year
This is a
yield we're looking
2-year.
at.
I mean, technically, it's just
Yeah, look
starts
at
a
those.
mess, but it's broken out. I mean,
So Fed funds rate, we could see over 6% into next year.
you have the December contract trading 552 right now.
And that always has been revising higher. I
That's up
think
15 basis points just today. You have the August contract up 15 to 561. It was just 3 weeks ago. It was actually the middle of February. I was seeing a lot of traders in SOFR contracts, buying the 6% yielding bonds, puts for the overnight rate. So
wow.
these guys were betting on 6% back in the middle of February after that CPI report. So yeah, I mean, I think we spoke about this in like the beginning of November.
Mm-hmm.
We were doing a show after the Fed meeting, and you asked me like, how high can rates go? And I said, well, if inflation doesn't start coming down soon, rates are going to go much higher.
Yes,
And that's pretty much what we've seen. And I
we've
think
seen that pattern play out. It's played
and I
out exactly like
and I
that.
think that story is still present. And I think a lot of people have been focused on, earnings coming down and that being the cause of a market drawdown. My focus has been on sticky inflation and higher rates and really the Fed. And people have, I think, kind of thought that maybe I've been too long there, meaning sticking around for too long. But I don't see a reason why that's still not the case.
Agree completely. We're seeing rising core month over month, and inflation takes a long time. It's cumulative. And I think that it's shown that it has not gone in the direction that Powell wants. He said that he wants to see clear evidence of inflation coming back to 2%. We don't see that.
No,
We have
if
a tight,
with January numbers, with the PCE report from January,
exactly.
you get another month of CPI like we did in January. I mean, you're talking about needing to get a 0.1 to a 0.2% CPI rate consistently over the next 6 months to be on that path.
And then
And
if gas and oil increase, as you said, during the summer,
right,
we're not, and that was the main reason why we dropped down was the energy prices. So,
right,
so I think
right.
we're in the same camp. I've been saying the same thing about persistently elevated inflation is a global challenge. And I actually spoke on a macro panel back in early December, and that was my main premise for the challenges that we have into this year and next, was that persistently elevated inflation is a global challenge. And I think that it's not only affecting us here, but we know in Europe and, across the world. So
Everywhere. It's everywhere.
it's everywhere.
And
It's a global.
it's not going to just, if it doesn't, it's not going to vanish here if it's a persistent problem everywhere else in the world. The only place that doesn't seem to have that problem for now is China. And that's because they were locked down for a year. But I mean, even Japan has a 4% inflation.
No, and they've been
And
the
this is a
uppers
country that was in, deflation for 40.
deflation exactly for so long. And I agree. And now, we talk about the equity risk premium, and we know that it's going to be higher rates. So that means the earnings yield should rise by about 25 to 50 basis points or more, like you discussed. So valuations, in order to stay relative to the bond yield changes, we are going to be seeing valuations come down, prices come down. It just makes mathematical sense.
I mean, what should happen is that credit spreads should widen, rates should
Yes,
go up, you should pay less, you should be, get more, you should be paid more for taking more risk,
exactly. And that's what
right?
the equity risk
And
premium is
and
telling
and
us. We
so,
need to be
you know,
compensated.
right, you should be seeing, high yield bonds trading higher at higher spreads than,
We
treasuries.
need better prices.
You should see corporate bonds trading at higher rates than treasuries, and you should see equity prices trading, at a discount relative also to corporate bonds and high yield, right? Equities are the most risky, and it's just not happening. It's
What do you
going.
think's holding up this market still? And it hasn't, I know it's finally revising.
There's just too much liquidity still in the system.
Mm.
The reverse repo activity every day, there's $2.2 trillion just sitting around with no place to go. I mean, that's what this is. That's what this facility is. It's where where money markets have nowhere to put their money because there's not enough bill issuance. There's not enough treasury bills. So they go to the reverse repo facility.
Mm-hmm.
They put their money there. They're getting their 4.5% right now over, annualized overnight rate. And this is all $2 trillion that didn't exist. Well, I mean, before the pandemic began.
Mm-hmm.
And when this disappears, that's when I think.
Wow, look at that chart. Wow.
I mean, this is, again, this was something that was created to kind of help to drain some. That's just all sitting there with no place to go.
That's significant.
I mean, now look what happens when I do this.
Mm-hmm. Let's see. And what is Michael going to do?
Let me make this. You can see, that this was during QE, right?
Mm-hmm.
So when there was QE, we were going up. As reserve balances were rising during QE, it had no impact on the market.
Mm-hmm.
But then when QE ended, you can see that as reverse repo activity increased, market came down, right? And what's more interesting is when you really get in closer, you can see that during periods where reverse repo activity really surged, you got big drawdowns in the equity market, and it's becoming more pronounced as we keep moving forward. And so this is sort of, another indication to me that, there's just too much liquidity sitting in the system. Reverse repos are a function of people parking their money, but it's also reflected in reserve balances. And so it's not surprising that as reverse repo activity has picked up, reserve balances have dropped, and you've seen the market sort of move down. And so until this money has nowhere to go, the market's gonna, I think that's really been one of the main drivers in terms of why you're not seeing prices falling more or trading more in line with where they should be, because there's just still too much. There's no place to put the money. And so people feel like there's still risk to be taken.
Wow, fascinating. Excellent point. How do you see that playing out? Any ideas of what you would
Reverse
think?
repo activity?
Mm-hmm.
Well, I mean, the theory goes is that as the Fed, continues with quantitative tightening and the balance sheet shrinks, there should be less reserve balances, and there should be less reverse repo activity. I mean, I've been reading people for months now saying that they expect reverse repo activity to fall below $2 trillion for
That's
months.
what I've been reading too. And it doesn't seem to be, I know, it doesn't seem to be occurring.
Hasn't happened yet. And so, beats me.
Yeah, exactly. So we're in this standstill. I think it's a sideways market, sideways grind for now, until we do something.
I mean, eventually once we get to a point where reserve balances really start to break, and you get to a point on quantitative tightening that reserve balances can start to drop again. That's really, I think, when it happens. But until then, as long as there's enough liquidity in the system,
Mm-hmm.
I think you're going to continue to see, equity prices continue to do this thing where they're not really reflecting what the true value should be.
Mm-hmm.
So
Yeah, I love that diamond that you have there. Interesting. Yeah, it seems like you said in before, was that we're basically back where we were before. I think earlier in the year, you made that comparison. It's like a sideways market. We go up and then we go down and we just stay in this sort of range bound.
yeah.
Um, and it's a trader's market. I would say day traders, you can go with the shorter term time frame and do some trading. You and I tend to be more longer term, and I'm swing as well. But for me, yeah, it's just sideways. So yeah, I reduced my positions like you have as well, and I'm waiting for hopefully better pricing. For all the issues we discussed, makes sense.
Yeah.
I mean, risk-free rates, 4.6, 4.7%, you can't beat that.
No.
It's not something we've had for quite some time. I think we said like 2007-ish time period. I was looking at the charts earlier.
Sure.
And and it's a different time period, and we have that recency bias. And many of the traders nowadays, there are a lot of newer traders that just started trading in the past 5 years or so, and they're not familiar with that. And plus, we all have short-term memory. So, we just have to adapt to the changing times. And we could very well be in this time period for quite some time. Fundamentals matter. And I know you and I are both fundamental investors. And, it's actually quite refreshing to see that the numbers matter. Rising earnings per share. I always look at the earnings reports. It's important when I identify any companies, look at guidance, look at how they're increasing or at least maintaining margins. All very important factors. Free cash flow yields. Cash is king, right? Even in an environment of higher rates of debt and capital, cost of debt and capital, cash matters. Cash is king. And that's
Yeah.
why money market funds are paying quite well, right?
That's why it's all in the reverse repo activity.
Exactly. I know it says the S&P. How are we doing today on the market?
We're down 1.2%.
Okay.
We're giving back some of the Bostic bottom.
I like that term, the Bostic bottom.
I don't know. I just tried to think of something catchy the other day, and it came up with that.
I like it. The Bostic bottom. That's
right here. Oh no, right here.
So what do you think time period wise? Just your thinking, looking at all this and all your studies, we could be in this time period for quite some time with all that liquidity we have, and looking at the equity risk premium and how expensive the market appears to be.
Unfortunately, this is all, it's all about, and unfortunately, it all comes back to financial conditions. As long as financial conditions stay easy and there's liquidity in the market and access to leverage is there, you're going to continue to see a market that's sort of buoyant. And if financial conditions really start to tighten again and access to leverage sort of dries up and it's not as easy to get some of that cash that's just sitting on the sideline, then you're going to start seeing the market fall. And it really, everything comes down to inflation, the market, prices, rates, spreads. They all come down to financial conditions. And we're still very much in a market where financial conditions are the driving force. And unfortunately, markets are the driver of financial conditions for the most part. And so as long as markets want to keep financial conditions loose, you're going to continue to see an S&P 500 that defies gravity. But the one thing I will point out in all of this is that financial conditions have eased, like I showed you, dramatically back to levels not seen since March. I meant March of last year, right?
Mm-hmm.
But the difference is that in March of last year, you had an S&P 500 that was trading, as high as 4,600 and as low as 4,200. And right now we're at, 4,000, call it. So despite financial conditions easing back to March-like levels, we haven't rebounded nearly as much in actual equity prices. And so what that sort of tells you is that if financial conditions do start to tighten again, which I suspect they will, because the Fed needs them to tighten,
Yes.
we will probably see new lows.
And now you wrote about it in your Seeking Alpha, and I love when you give us all the calculations about what range. You said NASDAQ, you had said maybe in the tens. SPX, we're looking at S&P 500 chart right now. What level about would you say we could go to?
Right there,
What is that? I can't read that.
3,200.
That's what I thought. That's the magic number. 3,200. That's what I've been reading, and I've been calculating myself based on these earnings levels.
I think that's a key level. I think if we get there, it's a very important level because it matches the lows September,
Looking at
October.
that chart, yes.
If that breaks, then I'm not really certain. But that's sort of my base case because that gets me to call it 14 times 2023 earnings estimates. And so that's what I've been looking for. And I think that becomes more of a fair valuation for the market. And I think at that price, I mean, you're talking a different ball game. I think even if you get into the 34 or 3,500s, you're talking a very different ball game because your risk reward ratio starts to shift from, going lower to going higher again. But I mean, ultimately, that's what I've been looking for some time now. And so, we'll have to just be patient and see
Exactly.
this plays out. But again, if financial conditions start to tighten as they should, then
we could see those levels. And I was looking at SPX 15.5 to 16. We're looking at about 3,500 value level price point there. So I was thinking 3,500 seems very plausible. But
I mean, that's the
right
lows
there.
of October.
That's the October lows. Exactly. I love these charts.
I mean, that's not that far away. I mean, what is that? Like it's a little more than a 10% drop.
Looking at this chart right here, we're seeing lower highs and lower lows. You see that pattern right there going from that high right there? It's a lower highs and lower lows.
Lower lows. The only thing is we haven't made another low. We haven't made another low yet. And we have this one sort of intermediate low, which was
right
higher.
There. Yes. So that's a higher
There's
low.
a lot of people thinking that, it's a bullish trend because the market is rising.
Right there.
But look, you broke the uptrend again. So then you can move it out to here if you want to.
Yeah.
Right. But still the point being is that, the bulls will hang on this for as long as they can. Once this is definitive that there's not this is no longer the case, and you take out this low at 3,800, ball game.
Exactly. And we have a lot of economic events coming. We have CPI the 14th next week.
Right.
And so we have a lot of and then we have the Fed in March.
5% drop.
Yeah, we have the Fed coming up, and then we have the Fed skips April, we have May. So we have a lot of, reality can sink in pretty quickly. And we know that
the equity market has underpriced risk. The VIX is at the low, right? And so you get a hard job report. People start worrying about a 50 basis point rate hike again. VIX isn't going to be 19.
Exactly. Yeah, the VIX is very low. And what about the implied volatility? You were speaking about that, saying how it's elevated right now.
Yeah, so it's elevated for the short dated stuff.
This week because of all this labor data.
Because of all the labor data, but what you're seeing is that but yeah, I mean, if you look here, you can see that this is Powell tomorrow. Then we drop, and then we come back up for the job report. Then we drop again. Then we come back up for CPI. My guess is that by the time we get to this point, this data point will be somewhere up in here.
Yes.
Right? Probably maybe higher. So, we still have implied vol that needs to rise.
Exactly. Exciting times.
Yeah.
I guess so. So exciting. Always so wonderful speaking with you, Michael. I have to say, it's like we're old friends. Love talking to you. So much fun.
Go on forever, but it's
Yeah, we
got
could talk, we could
those
go
got to
on and
end at some
on.
point.
Yeah. So tell us your services, because I love reading your Seeking Alpha, and I think all of our people will also love reading it. Tell us what you offer for everyone, please.
So I have I write for the Seeking Alpha platform. I write for other platforms as well, like investing.com. I also have a marketplace service on Seeking Alpha, which is for subscribers of my service. Every day we just kind of do this, and I just go through the markets with you, talking about what I'm seeing in it, what it potentially means, and what it potentially means for the longer term or short term outcome. I have an active chat room where I'll post comments and thoughts throughout the day, do Q&A sessions. We do live Zoom sessions. I like to try to make it as fun as possible too, but it's also a good learning experience. And then, I also run a long only thematic growth portfolio where I look for long-term investing ideas, usually things that my kids are doing or something that I'm experiencing in my life personally. And then I kind of dig into those ideas and those thoughts, and then I try to find companies that match them that are, reasonably valued. And that's basically what I do. It's more of a hobby,
Wow.
it feels like to me, but
You love what you do. You're very passionate. And I love all your stuff. I love reading your articles. That's how I found you on Seeking Alpha.
yeah,
But how smart. I love it. I also do the same. You look at forward trends and we learn from our kids and we see what they're into and what they're, what the younger generation is going to be going into. And then that's, part of how we establish our investment ideas is looking at innovation. And as that's the key to growth. I think
well, not only that, but I mean, these, the kids are, these sort of things that we have, that these kids grow up with. And, we didn't have iPhones when we were kids, but my kids have iPhones. And so it's sort of ingrained in their life, right? Chances are they're never going to own an Android. They're going to own an iPhone, right?
I have an Android.
Oh, you do?
Yeah. Uh-oh, I have to switch, right?
But you know what it is? I find that once you're on the platform, you just stay there because you don't want to have to move all your stuff, right?
It's true. You're in
Because
that
I had an
universe.
Android many years ago, and then I switched to iPhone, and it was like a pain because I had all my pictures and photos on the Android, and it was like, what am I supposed to do with them now? So I just find that, people tend to stay sticky with that product once they have it. But kids today, as I mean, they learn how to do something and it just sticks with them. And so if they're, doing something and they're shopping Lululemon like every day of the week, like, my kids, I feel like my daughter wants Lululemon all the time. I mean, I haven't bought Lululemon. I haven't really thought about it that much yet because it's kind of clothing, but, you know, chances are she's going to like it for the next 10 or 15 years until she either gets older or the fad changes. And so that gives you something that you can maybe tangibly work with for 10 or 15 years,
Absolutely. There's some
And
solid essential retail out there, and Lululemon's definitely one of them.
right.
I hear a lot of the females, even, moms that I know of love Lululemon.
Yeah.
So yeah, absolutely. And Ulta Beauty, beauty always sells, I guess,
Sure.
fashion, beauty, some of those companies. And I do think retail is here to, those companies are solid, in my opinion, not financial advice, but yeah, great companies to look at. And that's building a long-term customer, as you said,
Right.
10, 15 years of style. And I'm sure some of these companies will remain adaptable and keep growing. Like look at
Sure.
Apple. They went from the computer and now it's just the phone that everyone needs. It's like an essential universe.
Right.
Apple has just an amazing company.
Right.
And I
I mean,
think once I go Apple, I'll never go back.
look at Nike. I mean,
Wow.
kids
Yeah.
are walking around in Air Jordans that I owned in third grade because they brought back the style. And
Yeah.
so, Air Jordans that were popular when I was in the third and fourth grade are popular again, and people are paying, crazy money for them. So yeah, I mean, they're
It's amazing watching the business, looking at it from a business point of view. I love studying businesses and how they're able to adapt and they market to the younger generation. So they become part of their life as well. So what was popular in us, now they're marketing to the younger generation, and they're just staying like a generational company. And it's impressive. It's really a fascinating study to know how businesses do that.
Right.
Yeah, Nike's another fantastic example. They're quite, I'm always looking at the essentials. I think during this time period that we're in, I think there are many medical, there's a lot of industries like staples and that we talk about that are just essential, inelastic, and people will buy them no matter what. That's like the last thing they'll cut out of their budget is like an iPhone, for example. Like everyone what has to have, that's like essential. Your whole life is on there, right? I'm sure if you didn't have your iPhone, you probably feel lost, right?
Oh yeah, absolutely.
Absolutely, me too, with my Android.
Yeah.
So, but thank you so much for everything. And thank you to all the listeners. We appreciate you all. And Michael and I will definitely be doing these often as we have, probably at least once a month, maybe more. So stay tuned.
Yeah, thanks anytime.
Thank you.
Bye.
Thank you for listening to the Rose Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.